On January 30th, 2026, something happened that exposed a secret the financial system has been hiding for decades. Silver crashed 35% on paper, but in Shanghai, physical silver kept trading near $120 per ounce. Same metal, same planet, two completely different prices. The crash did not prove silver is worthless. It proved that the price you see on your screen has almost nothing to do with what real silver is worth in the real world. And if you own silver in any form, understanding exactly what the crash just proved could be the most important thing you learn all year. Let me start with one number, 14-1. That was the leverage ratio on COMEX on the day silver crashed. 108.7 million ounces of real silver in the vaults, over 1.5 billion ounces of paper silver outstanding in contracts, 14 paper ounces promised for every 1 real ounce that actually existed. And some estimates put the broader paper to physical ratio as high as 350-1. When that system came under stress and leveraged traders got margin called, the paper price collapsed instantly because paper can be sold infinitely. But the physical price in Shanghai held because you cannot create physical silver from nothing. Physical reality has constraints that paper never will. Here is how the paper system works and why it failed. On COMEX, traders buy and sell contracts representing 5,000 ounces of silver. The overwhelming majority are never settled with real metal. The entire system works on one assumption. Nobody asks for delivery all at once. In January 2026, that assumption failed. 33 million ounces of physical silver were withdrawn from COMEX vaults in just 7 days, 26% of total registered inventory, gone in 1 week. COMEX responded by raising margin requirements dramatically. Traders using leverage were forced to close positions immediately. Mass forced selling created the waterfall. Declined from $121 to $67. The paper price did not fall because demand for real silver fell. It fell because the rules of the paper game changed and leveraged players were forced out simultaneously. Meanwhile, the physical market told a completely different story. While COMEX futures collapsed, physical silver in Shanghai kept trading at 42.54% above the official paper price. In Japan, physical premiums reached 60% above spot. In Dubai, retail silver was clearing near $95 to $100. When futures showed 70, in the United States, coins and bars were trading 9 to 13% above spot. Same metal, massively different prices depending on whether you were buying a paper promise or the real thing. This is what the crash just proved above everything else. Physical silver and paper silver are not the same asset. They were treated as the same asset for decades because the system appeared to work. The crash revealed that the appearance was built entirely on the assumption of low delivery demand. When delivery demand rose, the paper price and the physical price went in different directions simultaneously. Now here is what this means for what you actually own. If you hold physical silver in your hand or in a properly allocated vault, the crash did not change what you own. You own real silver. It cannot be margin called. Nobody can force you to sell at the worst moment. The physical premium data shows that real buyers in every major market were paying significantly more than the COMEX price. Even at the depths of the crash, your physical silver was worth more than your screen showed you. The screen was showing you what paper traders were willing to pay for a promise, not what physical buyers were willing to pay for real metal. If you hold paper silver through an ETF or a futures contract, your exposure during the crash was entirely to the paper price. The SLV ETF saw over $3.6 billion in assets exit in 2026. Those investors experienced the full paper price decline with none of the physical premium protection. And here is the detail most ETF holders have not processed. The SLV prospectus and similar documents for most silver ETFs contain language describing scenarios under which holdings may be settled in cash rather than physical delivery. You are not guaranteed to receive physical silver. You are guaranteed to receive something of equivalent paper value. When paper silver trades 40 to 80% below physical silver in real markets, equivalent paper value is not the same as equivalent physical value. Before going further, hit the like button and subscribe. Turn on notifications so you never miss an update like this one during fast-moving market situations. It is free and it genuinely matters when things move this quickly. Now back to the most important part. The crash of 2026 also proved something bigger than just the physical versus paper distinction. It proved that the paper pricing mechanism itself is under stress. The system that sets the official global silver price has a 352-1 mismatch between paper promises and physical reality between 2020 and 2026, COMEX registered inventories fell over 70%. The pool of physical metal available to back the paper system is shrinking while the paper system grows. That trajectory has only one possible endpoint. Either the paper price rises dramatically to meet physical reality or the paper system loses its authority to set the price entirely. China made this trajectory structural on January 1, 2026 by restricting refined silver exports to just 44 state-approved companies. China refines 60–70% of the world's silver. That flow of Chinese refined silver into Western markets was the primary mechanism allowing Western dealers to plug supply gaps when COMEX inventory ran low. That safety valve is now closed by government policy. The physical shortage in Western markets has become structural, and structural shortages do not compress back to normal even when paper prices fall. The manipulation angle is also worth addressing honestly. From 2016 to 2025, global banks paid over $1.2 billion in legal settlements for manipulating precious metals prices. JP Morgan alone paid $920 million for spoofing silver and gold futures markets over 8 years. This is documented legal history, not theory. The manipulation worked by flooding the paper futures market with fake sell orders to create artificial downward price pressure. It worked because in a paper-dominated pricing system you can move prices without touching a single physical ounce. The crash of 2026 showed what happens. When physical shortage overwhelms even the most aggressive paper suppression, the physical premium data, 40 to 80% above paper prices in real markets, was the physical world asserting what silver is actually worth when you must own the real thing. So here is the complete takeaway. Physical silver without leverage is a qualitatively different exposure than paper silver with leverage. Physical is ownership of a real scarce industrial and monetary metal. Paper is a bet on a price in a system with a 350-to-1 mismatch between promises and delivery capacity. The crash proved that difference in the most visible and dramatic way possible. If you hold physical silver, the crash proved you made the right structural decision regardless of how uncomfortable the paper price felt. Your metal was worth more than your screen showed at every moment of the worst paper selling. If you hold paper silver, the crash asked you a question only you can answer. Do you own silver because you believe in the fundamental physical scarcity story? Or do you own it purely as a financial instrument? If the former, the crash was an argument for converting at least some paper exposure to physical. The premium you pay above depressed spot prices is the market's honest assessment of what it costs to own the real thing versus the promise. The crash of 2026 is not just a silver story. It is a story about what happens when financial systems built on unlimited paper promises meet the physical constraints of the real world. Silver was the first major commodity to expose this tension visibly. It will not be the last. Drop your honest answer in the comments below. Are you holding physical silver, paper silver, or both? And did the crash change how you think about that difference? Share this video with one person who owns silver in any form. Understanding what the crash just proved about physical versus paper may be the most valuable context any silver investor can have right now. See you in the next one.